Hello, and welcome back to Accounting 2301 Radio. This is your host, Professor Naragon, bringing you the awesome hits of Chapter 8 homework, coming to you live with depreciation and fixed assets. So, again, we're going to be looking at how Chapter 8 works with fixed assets and probably all three methods of depreciation, including disposal of assets and probably the sale. So let's start it off. Again, plenty of videos. Let's get through all these videos real quick. Again, I'll always suggest go ahead and watch these. Gives you plenty of info. Can never go wrong with too many resources. So we're going to start off with question 7. It's going to ask, Kegler Bowling installs automatic scorekeeping equipment with an invoice costing of $160,000. The electrical work required for the installation cost was $16,500. Additional costs are $3,300 for delivery and $11,510 for sales. During the installation, a component of the equipment is carelessly left on the lane and was hit by the automatic lane cleaning machine. The cost of repairing the component is $1,550. Okay, I want you to actually say what is the total recording cost of the automatic scorekeeping. Okay, basically, what are we including or excluding from the capitalized cost? How much did it truly cost us to get this machine ready to go to basically set up and go? So first off, it's going to say include or exclude. Of course, the cost of the machine is included. Now, electrical work required for installation. That, or setting it up, it can't work unless it's got the electrical work done. So of course that's included also. And then any freight and sales tax is included. Now this repair cost, we're going to have to look at this. One, we got to make sure it doesn't follow any of the rules that would exclude it from it. Yes, it's repairs. Yes, we need it to set up. But look at this line right here. This is the line that tells everything. It says during the installation, the component of equipment was carelessly left. So we already had this component, but someone just left it on the lane and got hit by the automatic lane clean machine. So this is considered basically an accident or a mistake. With that being the case, this is not a part of the capitalization of this machine to get it ready. This is a true expense because it was a mistake. We don't capitalize mistakes. Okay? Again, you can hit check my work and everything's good. So, this one, the repair work is just a little off. Now, if this was a used machine and we had to repair it to get it up and running, that will be part of the capitalized cost. But here, everything goes to machinery. Okay, except for the repair because that was again a mistake that actually happened. Someone just left it. Okay. Question 8. On January 2nd, the Matthews Band. Surprisingly, we didn't do Dave Matthews. Whatever happened to that band? Anyway, acquires sound equipment for a concert performance at a cost of $68,800. The band estimates it will use the equipment for 4 years, during which time it anticipates performing about 200 concerts. It estimates that after 4 years it can sell the equipment for $1,000. So, during the year 2017, the band performs 45 concerts. Okay, So we're going to deal with one of the depreciation methods right here. This happens to be straight line. Okay, so with straight line, we're going to know it's going to be cost minus salvage divided by life. Okay, so for us, cost, let me find the cost. Cost was $68,800. Let's see if they think that they can sell it later. Basically, their salvage value is at $1,000. So 68,800 minus 1,000 is a grand old total of 67,800. Now we divide by how long that they think the equipment's going to be good for. So the band estimates it's going to be about 4 years. Okay, so with that, let's do it in our calculator because Connect's not helping us this time around. It's not solving it for us. So bring in 6,7,800 divided by that good old 4 years. We find out that for a full year, depreciation is 16,000. What was it? 950. All right. So 16,950. Boom. Now, this is for a whole year. Notice that it does start on January 2nd. So basically, they had it for the whole year. So we're good to go on that. Check my work. Everything's good. Oh, hey. Now, judging by these numbers right here, the 200 concerts and the 45, we could even use units of output. In fact, here it is. I mean, looks like units of production. This is how it's the same term as units of output. So again, Matthew's band, the numbers are going to change just a little bit because it's a different problem. It wasn't linked up. So we're going to do the same thing on this. First off, formula is still cost minus salvage, our residual value, divided by total units of production. Okay? And then wants us to find depreciation per concert. So we actually have to do the formula. So we're going to take the cost. So I'm going to actually do this right here. Cost for us was 67,800. Whoops. Minus 2,000. Yeah, salvage value of 2,000. And then we're going to divide it by the number of concerts they anticipate to do during the lifespan of this equipment. So divide by 200. So it says the cost per concert is going to be $329. Okay? Then we take however many concerts they actually performed. Here they only performed 55. And now Connect actually solves it for you. Yay. So check my work. Everything's good. Rock on. We just hit 2 of the depreciation methods. Again, straight line and units. So there's still that third one. Yeah, you know it. It's coming. A double declining depreciation. Oh, here it is. A nice little chart that they decide to do for us. So we're going to take a fleet of refrigerated delivery trucks. Oh yeah, delivery trucks. And it is acquired on January 5th, 2017. Again, it's not January 1st, but since it's so early in January, we can do the whole year. Don't have to worry about partial time. Okay? At a cost of $970,000 with an estimated useful life of 8 years. And an estimated salvage value of $87,300. Okay. Compute the depreciation expense for the first 3 years using the double declining method. Alright, again, when we look at beginning a period book value on the first year, it will always be initial cost. We are not focused on salvage value. So my initial cost was $970,000. Now we actually have to compute the depreciation rate. So let's find that out. First off, we want to know the useful life. That's 8 years. So it's always going to be 1 divided by useful life, 8. So that's our straight line single rate going on there. So all we do is take that rate and times it by 2. So our actual rate is 25%. And this is going to be the same rate for all 3 years. So no worries on that. And we just have to calculate depreciation expense. So take the 970, times it by 0.25. So first one is 242,500. Okay, so notice right here, Connect's already given it to you, the accumulated depreciation, and it's also giving you book value. Remember, book value is the beginning book value minus any accumulated depreciation. Well, since Connect's given this to us, all we have to do is take this number, bring it here. Okay, and we're doing the same thing. We take 727,500. Sure, I got it. Yeah. And times it by 0.25. So 181,875. Okay. So now our book value's there. 545,625 times now that by 25%. And we're looking at a little bit of rounding that's going to happen. Let's see, it says round your answers to the nearest dollar. So since this is below 5, it's just going to be the 136,406. Alright, so that's the first 3 years. Check my work. Everything's good. Okay, so the biggest thing here is first you gotta get that depreciation rate. Okay, so again, when we're dealing with double declining, make sure you take 1 divided by the useful life and then times it by 2. And all you have to do each year is take the rate, times it by book value, gets us the depreciation. Then take the book value minus depreciation expense will get you next year's book value, and so forth and so on. Okay? So let's see what question 11 has up its sleeve. Alright, so Garcia Co's coming back. It owns equipment that costs $79,200 with accumulated depreciation of $42,000. Garcia sells the equipment for cash. Cool. Record the sale of equipment under the following 3 separate cases. Assume Garcia sells the equipment for $48,800 cash, $37,200 cash, and good old $32,100. Alright, so we're looking at either something that's a gain or a loss. Okay, so first off, we know the accumulated depreciation. We're probably assuming that happens in the year. At the end of the year, it's not giving us a date. So first thing we have to record is what we are receiving for that equipment. And we're going to be receiving cash. This time it is $48,800. The other debit we're going to see is accumulated depreciation. Okay, remember, we now have to basically reduce this, get rid of it, because we no longer own the equipment that was associated to it. Okay, so next one we're going to put in the equipment, and since the equipment's no longer with us, we have to credit their account for the full amount. Again, we no longer own that equipment. It is now gone on us. But if you look at this definitely does not look like it's in balance right now. Debit is outweighing the credits. If I have to, just add the two numbers. So 48,800 plus the 42,000. Okay, so on the debit side right now, we have like 90,000 going on. 90,800. Okay, that definitely does not match this 79,200. So we're going to have to increase the amount. So that means we're going to have a credit. So we're going to take that 90,800 and subtract 79,200. No, 79,200. Okay, so that means we have to increase our credit side by 11,600, and now it balances. Well, when this is a credit, this basically means a gain has happened on the sale. Okay, so credit, gain. As you see the process that I went through, this is usually the process that you should actually go. Take what you know and then find the difference. Okay, again, if you hit check my work, boom, everything is correct. So let's take the second scenario. It has lost more money, but it's still basically the same journal entry. Cash, 37,200. Accumulated depreciation, 42. And then equipment of 79,200. Okay, so let's add these two together. So 37,200 plus 42 is exactly 79,200. Whoa! So it's in balance. We don't have to worry about anything. Awesome sauce. Okay, cool. So there is no gain or loss. That's cool. Sometimes we do. We just break even. If we break even, things are good. Okay, so figuring the scenarios that are playing out on this question, we had a gain, we had no gain or loss. This one's probably going to favor the other way around. But still, we have cash of 32,100. Again, our accumulated depreciation. And I'm still going to put equipment right here of 79,200. Okay, so let's add these up and see how we're off. Most likely, this looks like it's already going to be less. And it indeed is. So this time around, we're going to need a debit to match it up to the equipment. So since we have to follow connect rules, this just means we gotta lower our equipment down 1, and we're going to have another debit. Okay, so to find the debit, again, just subtract the 2. So 79,200 minus 74,100 means debit side has to increase by 5,100. So when it increased by 5,100, this is now considered a loss. Okay, so again, exchange of assets. There we go. Loss on sale of equipment. Alright. So with this, again, if it's a debit, that basically is the plug for the loss or gain. If it's a debit, it's a loss. If it's a gain, it's a credit. Okay, so again, check my work. Boom, everything's correct. Yay. So again, the scenarios are here. If the debit is greater than the credit for the basically getting rid of the asset, we're going to have a gain. Because again, we got to increase this side to balance out. Sometimes you just break even. They're already balanced out. Then the last one, this time we have the credit is larger than the combined total of the debits. So we need to add a loss. Okay? So that's it of 11. Let's see what 12 brings us. 12 is dealing with straight line again. Okay, so straight line, Ramirez Company installs a computerized manufacturing machine in its factory at the beginning of the year at a cost of $47,500. The machine's useful life is estimated at 10 years or 405,000 units of production with a 7,000 salvage value. During its second year, the machine produces 34,500 units. Alright, so I can see the chain gang right here, down here. So that probably means that we're going to have basically a little bit of trouble going on. So what we need to do is go ahead and start our straight line. Again, it's cost minus salvage divided by the estimate useful life. So we have 47,500. We have a $7,000 salvage value, our residual value. Easy, real quick. 47,500 minus 7,000 is just 40,500. Okay. Then it asks us for life. Okay. So estimated useful years in life is 10 years. Means each year it should depreciate by 4,050 bucks. Again, I don't see a date up here, so we assume that it's bi-yearly. Okay. So year 2 depreciation. What is my depreciation expense basically for year 2? This is what it's asking. Well, straight line, depreciation expense does not change when it's a year. So it will be 4,050. Now, it's going to ask for year-end book value. Remember, book value is our initial cost minus accumulated depreciation. Since we got year 2, this means our straight line is times by 2 for year 1 and year 2. So we're going to take our initial cost, which is right up here, 47,500, and subtract out 8,100. Okay, so our book value at the end of year 2 should be 39,400. And we'll see if Connect is agreeing with us. It is. Cool. Gravy sauce. Alright, so let's see what question 13 is going to have. Most likely, if we have straight line, and I see units of production, it may jump to units of production. And it does. Oh wow. So, again, formula is going to look the same, except the denominator has estimated useful life. So, cost minus salvage is still that 40,500 divided by now the units, 405,000 units, means each unit basically cost us 10 cents in depreciation. I know, exciting, ain't it? Oh wow, that machine is really going. Alright, so in year 2, it states that 34,500 was actually produced. So 34,500. And it wants to calculate depreciation expense. Well, it's 0.10 cents times 34,500. Again, you can use your calculator if you want to. And you're going to come out with 3,450. Okay. Again, let's see if we're still on the right path. Oops. I did not. I actually said it and clicked the wrong one. Total units of production. So, estimated units of production. And I end up picking the life one. Well, that's always good when we check the work. Just make sure, because I was saying the right one, I just clicked on the wrong one. It happens. But either way, there we go. So, again, total units of production going on. Alright, 14. 14's using double declining. Okay, so let's see what it's throwing up here. Okay, so we know it's beginning book value, and we're trying to figure out depreciation expense. And again, this is going to be double the straight line rate. Alright, so beginning book value, first year, again, is always the initial cost. Okay, does not compute with salvage value until the end. Remember, we cannot go below salvage value, but we're not doing that. Definitely not in 2 years. Okay, so again, it says about 10. So we're going to take our calculator, go 1 divided by 10, and times that by 2. Oops. And I thought this calculator would do that answer thing. So 20%. So again, we know this is already going to be 20% also. So to get the next year book value, we have to take the current book value and subtract out depreciation expense. So that's 47,500 minus 9,500 should be 38,000. Woo! Bingo! So right now, and we've gone through to question 14. Just finished the chain gang, and it looks like we haven't seen too many journal entries. I'm going to figure that it's probably going to be a journal entry at the end. Let's see. Again, don't know until it pops up. No? Doesn't look like a journal entry. Woo! No journal entry. Cool. So, we're looking at Apex Fitness Club. Alright. First rule of Apex Fitness Club, nobody mentions Apex Fitness Club. Haha. It uses straight line depreciation for the machine costing $28,700 with an estimated 4-year life and a 2,950 salvage value. So that residual value is back again. At the beginning of the 3rd year, Apex determines that the machine has 3 more years of useful life remaining. So this was going for 4 years. It completed 2 because this is the beginning of the 3rd, and wants to add 3 more. Okay, so looks like we're probably at around 5 years now. Okay, so after which it will have an estimated 2,500 salvage value. Alright, so let's see what's going on. Compute the machine book value at the end of its 2nd year. Okay, and then compute the amount of depreciation for each of the final 3 years, giving the revised estimate. Okay, so we're using straight line. So again, straight line, as we know, is the cost minus the salvage value. We are not focused on this one. We're only focused on the original. So 28,700 minus our salvage value of 2950, and then take that and divide it by our useful life. So it happens to be the 4 years. Estimate 4 years. Can't find the number. Okay, so it depreciated straight line about 64.37 and 50 cents. So all we gotta do is take that, and since we're looking for year 2 accumulated depreciation for 2 years, that's gonna be the 6437.5 times good old-fashioned 2 years, and that should be my accumulated depreciation. So 12,875, and remember, cost for book value is the cost minus whatever the accumulated depreciation is. So it just happens to be 12,875. Again, check. Everything's good. We know we can use the book value if we need to use it for the revision. So, required 2. Let's enter everything in. Needs required 1. So 15,825 goes right here. Okay, revised salvage value is now 2,500. So remember, when we're revising, it's like going forward. So whatever happens in the past is already done. So we're currently sitting at 15,825 on our accounts. We now say it can go longer with a shorter salvage value. Okay. So remainable disbookable depreciable cost. This line is just these two subtracted from each other, which that should be 13,325. Okay. Years of life remaining. Okay. It only completed 2 years. From here, it says that the machine has 3 more years. So it's only going to have 3 years, and then find the annual depreciation, which of course is 13,325 divided by 3 years. So round to the nearest whole dollar. Well, 6 again is greater than 5, so it's going to round up. So it should be like 4442. Let me see, 4442. Let's see if all of our math checks out. Yep, it does, and that's it. Okay, guys. So that's it for Chapter 8 homework. Again, if you have any questions whatsoever, make sure you put a comment below. I will make sure to answer it and clarify anything that needs to be done. And if you're not comfortable with that, you can always shoot an email. It does not hurt. I am more than grateful to help you out as many times as possible. Okay? So, again, this is the end of the episode of Accounting 2301, Chapter 8 Homework, with your host, Professor Naragon. Signing off. We'll see you later.